People asked Warren Buffett in the past why Berkshire Hathaway is not paying dividends. After all, he loves getting dividends from his portfolio companies, so why not pay them? And what are the lessons that investors can learn from Warren Buffett's views on dividends? These are the questions I will tackle in this video. And guys, at the end of this video, I will mention one resource on Warren Buffett that I found very helpful. And with that, let's get started. Berkshire Hathaway recent cash and short-term liquid investment balance hit $189 billion. And yet, there's no dividend from Berkshire Hathaway. Here's what Buffett had to say on this in the past.
The answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If we do that, the shareholder, whether they're taxable or whether they're not taxable, whether they're a foundation or whether they're living on income even, they are better off if we retain the money. Because if they were going to get $1 in dividends and it became worth $1.10 or $1.20 in market value immediately on a present value basis, they're better off selling a small percentage of their stock and realizing the required amount that way, and they will have more money when they get all through doing that than if we paid it in dividends.
Let's unpack this. Buffett states that dividends are an integral part of an investor's total returns. As you know, total returns include both price appreciation and dividends. But he also notes that an investor in Berkshire is much better off not receiving cash dividends. Instead, it is better for Berkshire to keep and reinvest this cash into other companies. And the reason is very simple. Historically, investors in Berkshire earned far more without dividends than with them. The math is simple and undeniable. For instance, Berkshire stock appreciated by 12% annually for the past 10 years. That is thanks to the company's reinvesting cash and earning outsized returns. If, let's say, Berkshire paid a dividend with a yield of 3 or 4%, an investor's total return would have been less than 12%. Why? Because by distributing cash, Berkshire would have less cash of its own to reinvest. On top of this, there will be less effect from compounding. Warren Buffett gives a detailed example with numbers in Berkshire's 2012 annual letter. I linked it in the description. All this boils down to the notion of capital allocation. In the same 2012 letter, Warren Buffett outlined what any company can do with its idle cash. These are reinvest cash, do acquisitions, repurchase shares, and pay dividends. Buffett underscores how Berkshire is focused on reinvesting cash and expanding its subsidiaries' economic mode. I made a video on economic mode and what it means if you'd like to check it out, it's linked here. But Buffett always asks his subsidiaries managers to find opportunities to invest in. This allows the Berkshire portfolio to stay competitive and expand its aggregate return on capital. Of course, it can become harder to find growth opportunities for a company in a mature industry. Take, for example, grocery giant Kroger. There are only so many grocery stores that Kroger can open profitably in a particular city. At some point, it's not worth it. Then comes the second way to increase profits, and that is to buy other companies. Kroger has been an avid buyer of other grocery chains in the past. Among them are Harris Teeter, Dillon's, City Market, and Fred Meyer, to name a few. Kroger has also been pursuing online retail and acquired VitaCost in 2014. But even acquiring other companies to increase shareholders' value has its own limits. At some point, it can become destructive. And here comes the third way to increase value, and that is through share repurchases. But this one is a little bit tricky. A company creates value if it repurchases its stock at a price that is below its intrinsic value. Otherwise, share repurchases would actually decrease value. Kroger and Berkshire Hathaway have pursued share buybacks throughout the years. And finally, when all else is futile on the totem pole of value creation, a company can pay dividends. Kroger does pay dividends. The same applies to other companies, especially the ones operating in mature markets. Among them are Altria, the cigarette manufacturer, with a 8% yield, Coca-Cola with 3.1% yield, and Chevron with 3.9% yield. We can see that the size of a company, its maturity, and available cash, among other things, plays a big role in the decision whether to pay dividends or not. And of course, things may catch up to Berkshire Hathaway too. The company is already a giant, and probably Buffett and his managers are already limiting their investable universe only to large-cap companies. Only mega companies such as Apple, for instance, or Chevron can make a dent in the Berkshire's performance. In other words, investing in small-cap or mid-cap companies and stocks makes very little difference for Berkshire's performance. And at some point, as the opportunity pool for Berkshire shrinks, it may institute its own dividend policy. As we see, Warren Buffett expressed his opinion on dividends only through the lens of Berkshire Hathaway. And with that being said, are there any lessons that we can draw as individual investors from Buffett's line of thinking? Here are a few. First, the conclusion from Buffett's thoughts on dividends is this: investing in growth stocks can generate higher returns. There's nothing new here. While he uses an example of Berkshire Hathaway, it applies to any other growth stock. In their 1961 paper, Miller and Modigliani presented a theoretical argument. They said that investors should be indifferent to the source of their returns, be it capital gains or dividends. Investors tend to like dividend stocks for their income potential, but higher yields do not necessarily translate into higher total returns. Larry Swedrow, a stock market researcher, points out the following historical data fact. He says that stocks with the same exposure to common factors have similar returns regardless of whether they pay dividends or not. What does it mean? If we take a universe of stocks, each one will be different. Common differences include market size, value, momentum, profitability, and quality. There are studies that account for these factors and standardize returns across stocks. And the conclusion is that these differences stand behind different returns. Dividends were irrelevant. Vanguard's research on dividends echoes this conclusion. They compare different portfolios. There's one that focuses on dividends, and there's another one that focuses on total returns. The total returns approach produced better results, and by better they mean better and more diversification. If we look at US stocks, about 40% of them pay dividends. Thus, if I focused on yield only, I would have to exclude the other 60%. All else equal, common sense tells us that this could make anyone's portfolio less robust. Moreover, the total returns approach gave better control over the size, timing, and taxation of withdrawals. The second conclusion that we can draw from Warren Buffett is this: focusing on free cash flows growth tends to produce better results long-term compared to just focusing on dividends. There were many stocks with no dividends that had outstanding performance for Berkshire Hathaway. Even take Apple with a measly 0.6% yield. It has been really good for Berkshire Hathaway. The third lesson from Warren Buffett on dividends is the following: an investor can pay himself a so-called self-dividend, or what Buffett refers as a sell-off option. All it means is that an investor in Berkshire Hathaway can sell his shares to fund his living expenses or any other expenditures. And the same logic applies to any other low-yielding or no-yield ETF, even those that track the S&P 500 index. With that aside, I can still imagine circumstances under which investors would still prefer dividend stocks. The common explanation is that dividends offer insurance against price fluctuations. For instance, what if there is a prolonged bear market and an investor has to sell at rock bottom prices? Or the price appreciation turns out to be lower than expected, generally speaking. In all these instances, dividends can provide that stable and recurring income stream. But I always still keep in mind that the dividends, they decrease stock prices after X dividend date. After all, dividends decrease companies' net worth dollar for dollar. In my opinion, these are all valid points. Even analysts point out that dividend investing is like buying into quality companies. And by quality, I mean that the dividend stocks may fluctuate or decline less in comparison to, say, S&P 500. Yes, there is some truth to that, and this becomes especially important to someone in retirement. If, let's say, I'm a very risk-averse retiree and I fear the loss of capital, a dividend ETF may look attractive to me. Not only do I get equity exposure, it will fluctuate less and let me receive regular income to pay my bills. Some investors just don't really care what the historical data crunching is telling them. Each of us have their own investment preferences that can overshadow everything else. And as long as you and I know the facts and still prefer dividend investing, there is nothing wrong with that. And finally, guys, here's what I found useful recently. I came across this biography book on Warren Buffett called The Snowball. I linked it in the description. I know that probably the longtime followers of Buffett have read this by now, but still, I wanted to throw it out there. There's one important lesson that this book reminded me of. Often some people quote Warren Buffett saying, "I just sit in my office and read all day." But this is not what happened in reality according to this biography. True, Buffett has been an avid reader, but he has been in constant pursuit of meaningful business relationships with others. This allowed him to source and weed out stock ideas by bouncing them against smart people. Of course, this is common sense, but I feel like often it gets lost and people forget about it. There are many other interesting things on Buffett that this book talks about too. And that is it for this video, guys. I hope you found it useful and you learned something new today. If you did, please give this video a like and subscribe to my channel for more content on investing. Thank you for watching.